Most people believe the future is built by louder technology, faster growth, and bigger risks. But history shows something quieter. The biggest fortunes are made where pressure builds, not where excitement lives. Today, money is afraid. Inflation eats purchasing power. Debt grows faster than income. Trust in systems is thinning. So here is the real question. When uncertainty becomes permanent, where does capital hide to survive and then expand? The next trillion-dollar industry won't look exciting at first. It will look necessary, ignored by crowds, accumulated by those who understand one thing most people don't. Money doesn't chase trends. It chases stability under stress. Most people believe money flows to what looks new, fast, and exciting. Headlines reinforce this illusion. Every cycle, attention is captured by innovation, disruption, and sudden growth. But attention is not capital. Real capital behaves very differently, especially large patient capital. Capital moves toward necessity because necessity creates forced demand. When something is necessary, spending continues regardless of mood, confidence, or economic conditions. When something is exciting, spending depends on optimism. Optimism is fragile. Necessity is not. This is a critical distinction. In strong economic periods, excitement dominates. People speculate. Businesses expand aggressively. Investors chase growth stories. But when pressure increases, inflation, debt stress, demographic shifts, geopolitical risk, behavior changes. Households cut discretionary spending first. Companies delay expansion. Governments reallocate budgets toward essentials. Capital follows this behavioral shift. History shows this pattern clearly. Industries tied to comfort, luxury, and aspiration rise quickly but fall hard. Industries tied to survival, stability, and continuity grow slowly and then become enormous. They don't need hype because they don't rely on choice. They rely on obligation. Necessity-based industries share three core characteristics. First, demand is non-optional. People cannot delay healthcare, infrastructure maintenance, energy reliability, or system security indefinitely. Even when budgets tighten, these expenses persist. In fact, they often increase during stress. Second, cost of failure exceeds cost of investment. When failure becomes more expensive than prevention, spending accelerates. This is where large capital becomes comfortable. Predictable demand, recurring revenue, and policy support reduce downside risk. Third, necessity attracts institutional capital. Pension funds, insurance companies, and sovereign capital avoid volatility. They don't chase excitement. They allocate toward long-term cash flows and system relevance. Once institutional money commits, scale follows. Excitement-based industries depend on narrative. Necessity-based industries depend on math. One fades when sentiment shifts. The other grows as pressure accumulates. This is why the biggest industries often look boring in their early stages. They lack emotional appeal. They don't promise transformation. They promise continuity. And continuity is what systems pay the most for when uncertainty rises. For the United States, this principle matters now more than ever. The economy is transitioning from expansion to preservation. Debt levels are high. Infrastructure is aging. Populations are older. Systems are more interconnected and fragile. In such an environment, capital prioritizes reliability over growth potential. The mistake most people make is confusing visibility with value. Exciting industries are visible. Necessary industries are embedded. They sit beneath the surface, quietly absorbing money year after year. The investor who understands this principle stops asking, what's growing fastest? They start asking, what cannot be allowed to fail? Because in the long run, capital does not reward excitement. It rewards what societies are forced to fund, even when times are hard. Most people assume great industries are born in moments of confidence. When economies are strong, optimism is high, and risk feels rewarded. This belief is comforting, but it is wrong. The largest and most durable industries do not emerge from optimism, they emerge from pressure. Pressure changes behavior. Optimism encourages choice. Pressure creates necessity. When an economy is comfortable, inefficiency is tolerated. Fragile systems survive because failure is rare. Capital experiments. But when pressure builds, rising costs, demographic strain, debt overload, or system complexity, tolerance disappears. Weak structures break. And when something breaks repeatedly, society is forced to fix it permanently. This is the birthplace of trillion-dollar industries. Pressure exposes what truly matters. It reveals which systems are essential and which are optional. Under stress, governments reallocate budgets, corporations change priorities, and households adjust spending. The flow of money becomes disciplined. Capital is no longer chasing upside. It is defending against downside. This is a crucial shift. Optimism-based industries depend on belief. Pressure-based industries depend on reality. Reality is far more reliable. Trillion-dollar industries share one defining feature. They solve problems that become too expensive to ignore. When the cost of doing nothing exceeds the cost of action, spending accelerates structurally. This is not a trend. It is a forced response. The money does not arrive because people are excited. It arrives because the alternative is unacceptable. This is why these industries often feel slow at first. Pressure builds gradually, problems compound quietly, then suddenly spending becomes permanent. Once this threshold is crossed, scale follows naturally. Another critical aspect of pressure-driven growth is policy alignment. Under stress, governments act, regulations change, subsidies appear, long-term contracts are issued. These actions are not ideological. They are defensive. Governments support industries that prevent systemic failure because stability is politically and economically mandatory. Capital understands this. Large investors do not fear regulation when it signals guaranteed demand. Pressure-backed policy creates visibility, predictability, and long-duration cash flows, the exact conditions required for massive capital deployment. Optimism creates bubbles, pressure creates infrastructure. One expands quickly and collapses. The other expands slowly and becomes permanent. This is why many of today's most valuable sectors were dismissed early. They looked unattractive because they were responding to problems, not dreams. But problems do not disappear. They accumulate interest. The United States is entering a high-pressure economic phase. Aging demographics, fiscal strain, system complexity, and global competition are not temporary. They are structural. That means the next wave of dominant industries will not promise excitement. They will promise continuity under stress. The investor who understands this principle stops chasing hope. They start analyzing pressure points, because in every cycle, the biggest fortunes are built not by predicting growth, but by positioning where pressure makes spending inevitable. Many investors instinctively avoid industries tied closely to government involvement. They associate regulation with inefficiency, slow growth, and political risk. On the surface, this reaction feels logical, but in long-term capital allocation, this thinking often misses a deeper truth. Government dependence is not a flaw. It is a signal. Governments do not fund optional systems. They fund what cannot be allowed to fail. When an industry becomes essential to national stability, public safety, economic continuity, or social order, government involvement increases. This involvement is not ideological, it is defensive. The state steps in when failure carries systemic consequences. From a capital perspective, this changes everything. Government-backed or government-dependent industries benefit from forced demand. Budgets may fluctuate, but funding rarely disappears. Even during recessions, these sectors are protected because cutting them increases risk elsewhere. This creates a rare environment where revenue is less sensitive to economic cycles. This is why large patient capital does not fear government proximity. Pension funds, insurance pools, and long-duration investors actively seek it. They understand that regulation often means predictability, not danger. Predictability is the foundation of scale. Another overlooked factor is policy reinforcement. When governments depend on an industry, they shape laws, subsidies, and procurement processes to ensure its survival. This builds structural advantages that newcomers struggle to overcome. Barriers to entry rise, competition narrows, margins stabilize over time. Critics often focus on inefficiency, but inefficiency is a short-term issue. System relevance is a long-term advantage. Government dependence also signals long-time horizons. Public infrastructure, defense, healthcare systems, and core services are planned decades ahead. Contracts are long. Commitments extend beyond election cycles. This aligns perfectly with capital that seeks durability rather than speed. Importantly, government reliance also shifts risk from the private balance sheet to the public one. When something becomes too important to fail, losses are socialized and continuity is preserved. This is not speculation, it is a recurring pattern in modern economies. The key mistake retail investors make is assuming that freedom equals opportunity and regulation equals limitation. In reality, regulation often defines where serious money feels safe to scale. Unregulated spaces grow fast but break easily. Regulated spaces grow slowly but endure. The next trillion-dollar industry will not avoid government, it will be intertwined with it. This does not mean blind trust in policy. It means understanding incentives. Governments prioritize stability, employment, and continuity. Industries aligned with these priorities receive support when stress rises. The intelligent investor reframes the question, not, is the government involved? But what happens if this industry fails? If the answer is systemic damage, capital should pay attention. Because in the long run, the most powerful signal in finance is not innovation or growth, it is institutional dependence. Demographics are one of the slowest forces in economics and also the most powerful. Technology can change quickly, policy can shift suddenly, but population structure moves gradually, predictably, and with long-lasting consequences. This is why aging societies quietly reshape entire economies. When a population is young, spending is expansionary. Money flows toward growth, consumption, housing, and new experiences. Risk is tolerated. Debt feels manageable because future income is expected to rise. Economic behavior is optimistic by nature. As a society ages, this behavior reverses. Older populations spend less on expansion and more on protection. The priority shifts from building more to preserving what already exists. Healthcare replaces consumption. Maintenance replaces construction. Reliability replaces speed. This transition is not cultural, it is biological and financial. An aging population carries three unavoidable economic realities. First, income growth slows. Retirees live on fixed or semi-fixed incomes. They are more sensitive to inflation and volatility. This reduces appetite for risk-based spending and increases demand for stable services. Second, system reliance increases. Older societies depend more heavily on healthcare systems, insurance mechanisms, utilities, and public services. These systems must function continuously. Failure is not an inconvenience, it is a crisis. Third, political incentives shift. Older populations vote. Governments respond by directing spending toward protection, benefits, and system stability. This reallocates capital away from growth experiments and toward essential infrastructure. This demographic shift redirects money flows at scale. Entire industries rise not because they innovate, but because they serve unavoidable needs. Spending becomes less discretionary and more contractual. From a capital perspective, this matters deeply. Industries serving aging societies benefit from persistent demand. Even during economic downturns, spending continues because the needs are non-negotiable. In many cases, demand increases precisely when economic conditions worsen. This is why some sectors grow quietly for decades. They do not depend on optimism or population growth. They depend on inevitability. The United States is entering this phase. The median age is rising. The worker-to-retiree ratio is shrinking. Healthcare, infrastructure maintenance, insurance systems, and service reliability are becoming central economic priorities. These are not short-term trends. They are multi-decade reallocations of capital. The mistake many investors make is focusing only on innovation cycles while ignoring demographic cycles. Innovation creates opportunities, demographics create certainty. Aging societies do not stop spending, they stop gambling. They channel money toward industries that reduce uncertainty, extend functionality, and preserve quality of life. These industries may not grow explosively, but they grow consistently, and consistency compounds into scale. The investor who understands demographics stops asking, "What's new?" They ask, "What becomes unavoidable as society ages?" Because in the long run, populations don't vote for growth, they vote for security. Modern economies are not built on simple systems. They are layered, interconnected, and tightly synchronized. Energy grids depend on software. Healthcare depends on data. Supply chains depend on logistics, sensors, and real-time coordination. As complexity increases, efficiency improves, but fragility rises with it. This is the hidden cost of progress. Simple systems fail visibly and quickly. Complex systems fail quietly, slowly, and expensively. When one component breaks, the damage spreads. Downtime compounds. Small disruptions create large consequences. This changes how capital values control and maintenance. In early stages of economic development, investment flows toward creation. Build more, expand faster, innovate aggressively. Maintenance is an afterthought. But once systems reach scale, maintenance becomes more valuable than expansion. Preventing failure is cheaper than rebuilding after collapse. This is where money shifts. Control and maintenance-based industries grow not because they are innovative, but because they are defensive. They reduce uncertainty. They stabilize outcomes. They protect existing capital rather than risking new capital. As systems become more complex, three economic dynamics emerge. First, failure costs rise non-linearly. A single outage can halt production, disrupt markets, or endanger lives. When failure becomes catastrophic, spending on prevention becomes mandatory. Second, expertise becomes scarce. Complex systems require specialized knowledge to manage, monitor, and repair. This creates pricing power for firms that control reliability. Third, recurring spending replaces one-time investment. Complex systems are never finished. They require constant updates, oversight, and adaptation. This creates predictable, long-duration cash flows, the most valuable type of revenue in finance. This is why some of the most powerful industries are invisible to the public. They operate in the background, ensuring systems continue to function. They don't generate excitement because success looks like nothing happening. But from a capital perspective, this is ideal. Industries focused on control and maintenance benefit from high switching costs. Once integrated into a system, replacing them becomes risky. This creates durable market positions and long-term contracts. The United States economy is now deeply complex. Infrastructure is aging. Digital and physical systems are intertwined. The margin for error is shrinking. As complexity grows, so does the value of those who can manage it. The mistake many investors make is chasing innovation while ignoring upkeep. Innovation attracts attention. Maintenance attracts money, quietly and consistently. In advanced economies, the largest industries are not those that build the future from scratch. They are the ones that keep the present from breaking. The intelligent investor reframes their thinking. Not what's the next big thing, but what becomes too complex to risk failure. Because in a complex world, wealth does not belong to the fastest builders, it belongs to those who control stability. Most investors are taught to predict growth, predict trends, predict what comes next. This mindset feels productive because it creates the illusion of control. But prediction is fragile. It depends on timing, sentiment, and assumptions that rarely survive real economic pressure. Long-term wealth is built differently. It is built by owning solutions to permanent problems. Predictions are opinions about the future. Solutions are responses to reality. When an industry solves a recurring, unavoidable problem, demand does not depend on forecasts. It depends on persistence. Problems do not disappear because sentiment changes. They compound until addressed. This distinction separates speculation from ownership. Prediction-based investing requires being right and being early. Both conditions must align. Solution-based investing requires only one thing, that the problem continues to exist. In complex economies, most foundational problems never fully disappear. They evolve, expand, and become more expensive to manage. This is why durable wealth concentrates around boring words: services, systems, infrastructure, maintenance, compliance, and protection. These are not exciting narratives. They are permanent needs. Another critical advantage of solution ownership is pricing power. When a problem is essential and alternatives are limited, solutions can raise prices without destroying demand. This is not exploitation, it is economics. The value provided exceeds the cost of inaction. Prediction-based assets rarely have this advantage. When optimism fades, prices collapse. But solution-based businesses often strengthen during stress because the problem becomes more visible. There is also a time component. Solutions compound. Each year of integration, regulation, and customer dependence increases switching costs. This builds economic moats that speculation cannot replicate. Large capital understands this. Pension funds and endowments do not attempt to predict the future every quarter. They allocate toward assets that quietly solve problems decade after decade. Their goal is not maximum upside. It is maximum endurance. The United States economy increasingly rewards this mindset. The future is less about explosive growth and more about managing accumulated complexity, demographic shifts, and systemic risk. These are not temporary challenges. They are structural conditions. The mistake many individuals make is confusing intelligence with foresight. In reality, intelligence in investing is often about humility, accepting that the future is uncertain and positioning accordingly. The most reliable strategy is not guessing what will happen. It is owning what remains necessary no matter what happens. This reframes the role of the investor, from forecaster to allocator, from trend chaser to problem owner. Because in the long run, markets do not reward those who predict the future best. They reward those who own the solutions the future cannot live without. The next trillion-dollar industry will not announce itself with headlines. It will grow silently, funded by necessity, reinforced by policy, and protected by economics. Quick money looks for excitement, serious money looks for endurance, and in every era, the greatest fortunes belong to those who understand one quiet truth: the future pays those who protect it, not those who gamble on it.